Hi, it's Jason from Aquest Wealth. In this video, we'll be discussing Social Security tax killers.
I understand killers.
And a bunch of strategies on how to avoid this tax.
Yeah, I can do that. Yeah, let's do that.
So there are a few Social Security killers, meaning incomes that you might have that are almost certainly going to cause all of your Social Security to be taxable. Those are pensions, non-qualified interest, dividends, and capital gains, and required minimum distributions.
Yeah, I can avoid that stuff, yes.
First, let's talk about pensions. If you have a halfway decent pension income, your Social Security is going to be fully taxable, and there really is nothing you can do about it. They're going to send you that pension check every month. The good news is, congratulations, you have it. The bad news is, it's going to throw off your provisional income calculation. So it has been nice to be able to share some information on Social Security with you, but you may as well turn off this video unless you're watching it for someone else.
Should we leave?
I think we should hear him out.
The next Social Security killer is non-qualified dividends, interest, and capital gains. First, let's define this odd word that I keep using, non-qualified. Non-qualified just means money that you have saved that is not in a tax-advantaged account like a 401k, an IRA, or a Roth. Most non-qualified interest comes from bank and bond interest. This interest is considered passive. So remember before we talked about earned income, this is passive income, and it's included in your total income for provisional income purposes. Of course, today, interest on banks is almost nothing, so it's actually much less of a problem than it used to be. But if interest rates normalize again anytime soon, this could become an issue that we'll have to deal with.
Well, that could be a problem.
All right, so the main source of dividends generally comes from individual stocks and mutual funds held in brokerage accounts. So those dividends, from Ford, if you live around here, I'm from the Detroit area, or a company like that, those dividends pay out. They are considered passive income, but they do affect your provisional income calculation as well as are taxable on your ordinary income tax return. The last source of non-qualified pension killers are capital gains. Most people think they understand how non-qualified accounts work, but they don't have as good of a handle on it as I would prefer. So most people think that non-qualified gains are when you, as a person, buy or sell something.
I don't think so.
Right? Well, that's actually capital appreciation. That is taxed as long as you hold them for a year at actually a different, and as of this filming, preferential tax rate. But how non-qualified gains actually work, it is not you. If you own a mutual fund, it is the mutual fund manager that is buying and selling and buying and selling. So when the mutual fund manager might own 200 or 300 stocks in their portfolio, and they buy Ford at $9 a share and sell it for $16 a share, and they only held it for, let's say, 4 months, well, that mutual fund is not a taxable entity. You are a taxable entity, though.
Why to me? Why me? Why?
So even though you did nothing, you did not buy nor sell any mutual fund in your portfolio, you get a 1099 with those non-qualified gains attached to them. When you do that, those non-qualified gains are going to be partially short-term and partially long-term, but that's going to be income, and that's going to affect not only your taxable income, but also your provisional income calculation.
Oh, this affects me too, All
right, so now that we see how non-qualified dividends, interest, and capital gains can kill a pension, what can we do about them? What, am I just sitting here yapping, or can I actually give you some solutions?
Time to nut up or shut up.
So there are several mitigation techniques out there to help you get the dividends, interest, and capital gains off of your income, or at least less, so that less of your Social Security is taxable. So let me add in that these are not going to be crazy strategies that only 1 in 1,000 people can do. These are going to be things, that almost everyone can do, and they work for most people.
Yeah, well, I ain't most people.
The first technique that people want to use is selling off some of their non-qualified investments and dumping them into municipal bonds.
Why would they do that?
The reason that they think this will work is because the interest paid by munis, and municipal bonds are called munis, are federally income tax free and sometimes state income tax free. And although this is true, the government has done us the favor of eliminating this strategy.
I'm the government.
Gee golly, thanks, mister.
So thanks a lot, Uncle Sam. Unfortunately, the tax-free municipal bond interest is added back for provisional income purposes. So it doesn't get taxed on your tax return, but it does get included in provisional income.
That is so unfair.
It's a scam. So moving the non-qualified interest to municipal bonds will work for federal income tax avoidance, but it is not going to work for avoiding your Social Security becoming taxable.
So what do we do now?
On the other hand, there is a strategy that will work, is investing in a non-qualified annuity. I know, boo, annuities are horrible and no one should ever, under any circumstance, ever have one.
I wouldn't do that if I were you.
I don't know if that's true, but I can tell you that non-qualified annuities are a tax-deferred investment, meaning that any funds you place into the annuity are not taxed until you take them out. Now, without getting into some big tax dissertation, let me just say that there are some disadvantages to this strategy, and you're going to want to talk to us or another financial advisor about those. But if your goal is to keep your Social Security tax-free by reducing or eliminating non-qualified dividends, interest, and capital gains, this will work. To understand if this strategy works for you, though, and again, it's pretty in-depth, so I would tell you, maybe don't do it on your own. Don't hesitate to contact us or whatever financial advisor you happen to be working with, to see if this is something that could work for you.
Well, let's find out.
The next strategy that works for some clients would be to purchase a life insurance policy.
Life insurance.
Bingo was his name.
This strategy, again, also has advantages and disadvantages, but it does work for the client who's in a certain financial situation. The way that this works is that the cash value of the life insurance grows tax-deferred, and under the right circumstances can actually be withdrawn or borrowed tax-free. Also, when you pass away, the death benefit of the life insurance is federal income tax-free to your heirs. In my experience, this strategy is overused, and my guess, and it's only a guess, is that it's financial advisors like to sell insurance because they earn commissions on it. So they use life insurance kind of as like a Swiss Army knife that's amazing in any client's situation. My perspective is that this is a strategy that can work to eliminate non-qualified dividends, interest, and capital gains, and then you could use that to reduce or eliminate the tax on your Social Security. Please make sure that you are using a certified financial planner to help you put all of the pieces of this puzzle together and not just go to someone who's trying to sell you some product.
I hate those guys.
Purchasing long-term care will work very similar to life insurance, although there usually isn't a cash value to borrow from or to withdraw. The strategy here would be to purchase a long-term care policy with some of the non-qualified savings. That gets the dividends, interest, and capital gains off of your tax return and off of your provisional income calculation. The benefits paid out if you are in need of long-term care tend to be tax-free, so you can kill two birds with one stone. Having long-term care, though, can be quite expensive, although it is appropriate for some people. Long-term care can also be added to some permanent life insurance policies that you can actually kind of kill three birds with one stone.
Birds? Yeah, birds.
A lot of birds.
By adding an income tax-free death benefit. Again, the reason we're not going in depth, these are very complex products and strategies, and I would suggest finding a well-qualified, certified financial planner to help you determine if they fit into your financial plan. It's exactly the kind of strategy work that Aquest Wealth is well known for, and we would love to have the opportunity to figure out, if this works for you or how all those puzzle pieces work together.
And you're so good at puzzles, I'm sure you'll figure it out.
Now, one of the best ways to mitigate the capital gains that we discussed is to just do away with actively managed mutual funds or to invest into mutual funds that don't trade as much. If you remember from a moment ago, the non-qualified capital gains are generated not when you make a trade, but when an active mutual fund manager actually is a human being that buys and sells. And when that manager sells stocks, and those stocks are held in a mutual fund managers get paid to attempt to drive the returns on the fund, not to manage your tax burden. So as they're trading, that tax gets passed through to you. Therefore, some managers have, a really high turnover, in some cases in excess of 100%.
Sometimes at 200%, sometimes 100%.
Meaning that every single stock in the fund could be sold in 1 year. Now, a mutual fund is not a taxable entity like I mentioned, but you are. That's why you get those 1099s from your mutual funds at the end of the year. That's included in your provisional income calculation. Now, some of those mutual fund managers understand that this is a problem, and they manage not only to drive return, but also to reduce that turnover. They're not buying and selling as much. They do this by purchasing generally high conviction stocks, something that they can hopefully hold for several years, maybe even 5 to 7 years, instead of trading multiple times in a year. So less buying and less selling leads to fewer capital gains flow-throughs to you on your tax return, And fewer capital gains reduces your income and could reduce or help eliminate the tax on your Social Security.
Isn't that our goal?
The other option is just to step away from those actively managed mutual funds altogether and invest in lower cost ETFs. Electronically traded funds, or ETFs, really have been taking over the investing world. They invest in pre-existing indices like the S&P 500, the NASDAQ, or the Dow. So there's very little trading because it's a set index. There's no human being that comes in and buys and sells and buys and sells. That makes them very popular, their tax efficiency, not only with individual investors, but also with financial advisors. We use a ton of ETFs.
Lots and lots of tons.
Now, in all of this, we discuss getting out of existing non-qualified actively managed mutual funds. Again, don't just watch this video and go crazy and sell all of your funds.
That would be incredibly bad.
Right? You could have a ton of gains embedded in those funds that could be taxable. And when you invested, you might have paid a commission, or there could be trading costs. So there's a lot of things to think about. Again, my suggestion would be find someone that is good. Go to a certified financial planner who has a tax person on their staff.
Will you just listen to the man?
I would say not just an advisor who can provide you a recommendation to someone down the street, but someone who has a person in-house so that they can work together to make sure that your situation is as efficient as it can be. All of these strategies require collaboration between your financial advisor and the tax professional. It is most efficient when they both work together, have access to the same information, and are on the same page.
Same page and on the same team.
Now, another pension killer is the required minimum distributions. The IRS is furious with you if you have an IRA balance at retirement. They know that you have never paid 1 cent of tax on any of that money in your pre-tax 401k. And similar to the mafia's business plan, they want their piece of the action.
We just want our cut.
Therefore, at the age of 72, the government requires you to begin taking withdrawals from your pre-tax accounts, IRA, 401k, 403b, any pre-tax retirement account that you have. Now, a lot of people believe that you actually have to withdraw the entire balance all at one time. That is not true.
I mean, we didn't have to...
And it used to be that you had to take it out at 70 and a half. That actually got changed in 2020 to 72. And there was actually some legislation on the House floor as of this filming for the House of Representatives that would actually bump it to 75. So this is in flux, but right now in 2021, if you're 72, you've got to take a required minimum distribution, and it is not the entire balance, right? That would be a nightmare, and it's not accurate.
Correct.
The government will require you in the first year to remove about 4% of the balance of all of your IRAs and 401ks and pre-tax retirement plans. Now, this percentage goes up a little bit every year. And a really good question is, but Jason, what happens if I forget to take my required minimum distribution? Or I just say forget it and I'm not going to take it?
What happens then?
That's actually a very good question. Because the penalty is, and sit down or hold on to something if you're not.
Hang on to something! Hang on to something!
The highest penalty in the entire tax code, which is 50% of what you should have taken. 50%. It's a huge number, and this is why it's very important to understand how this works and to get those funds out of there each year.
Hey, I'm glad you told me.
The best way to reduce those required minimum distributions, because again, that required minimum distribution comes out, it's taxable, and it affects your provisional income calculation. You can hear this, turn it off right now and say, oh, we shouldn't have any, honey, we don't need any money in our IRAs, and just go spend like crazy.
Alfred, let's go shopping.
Yes, sir.
Or you could do a Roth conversion. Roth conversions are a whole video series in and of themselves that we are going to have. But a good summary is just to say you can take money out of your IRA in an unlimited amount from your pre-tax IRA, 401k, anything you've got. And you could convert the funds within 60 days to a tax-free Roth IRA. The amount that you do that with, that you convert, is taxable. But there's a ton of situations where you're in a low tax bracket now when you first retire. But with required minimum distributions or a deferred Social Security, you're going to be in a higher bracket later, or even if you leave your money to your children who are doing relatively well and they're in a higher tax bracket.
The kids are doing well.
If you recently retired or are worried about the tax implications of your required minimum distributions, you should really contact us to see if those conversions could make sense for you. Now, thanks for checking out our videos, and be sure to hit the like button and share these with your friends or family. Also, if you have any questions about Social Security or would like a free consultation to discuss your financial future, be sure and contact us at aquestwealth.com, and we look forward to meeting with you. Have a good one.